Welcome back to the Best of Investing. I'm Edward Brown, your host. I'm in the studio here with Mark Hahn of Pacific Private Money, Brian Burke of Praxis Capital, and our special guest, Mike Zaidlin of Madrone Retirement Investors. And he's going to be talking more about retirement planning right after I give the question that we cut to commercial break with. Who was the University of Michigan basketball player who blew it when he called a timeout when his team had none remaining in 1993, which cost his team the championship against North Carolina? And I'm looking at blank stares. Chris Webber. Oh, yeah. I remember him.
Yep.
Played for the Warriors. And PJ Carlesimo with the choking incident and all that.
I think that was Latrell Sprewell.
You're right. You're right. It was Latrell
That could have been
Sprewell.
another trivia question.
That's right. And remember, Latrell had said when he was offered a $100 million contract and he wanted more, he says, "Hey, man, I got to feed my family." Yeah, I like that one.
I remember that.
Okay.
That's
Mark,
great.
you wanted to lead in with a question.
Yeah. Michael, in 2010, there was a big deal made about an opportunity, and I guess it was a one-time opportunity in 2010 to convert your traditional pre-tax IRAs into what's called a Roth. I guess it's post-tax, or maybe there's a better explanation for that. But is there still a reason to do that today? And if so, what are some of the factors you would take into consideration in converting your traditional to a Roth IRA?
Sure. Well, what you're referring to, I think, is what happened in 2010
Yes.
when a one-time, the ability to roll over your Roth into an IRA, roll over your traditional IRA into a Roth,
Right.
allowed you to split the tax over 2011 and 2012. So that was a really special deal.
Yeah, I want to have my.
You want to do over?
No, I want to flip it. I want to have my Roth go into my regular traditional IRA.
Well, let's take care
Sorry,
of
go
this
ahead.
one first.
Now that the audience is confused.
So, yeah, well, going after tax and making it
So-
suddenly pre-tax.
So yeah, yes, Mark, that there are still a lot of good reasons to consider, not necessarily to do, but to consider rolling a traditional IRA into a Roth. So, the factors that, well, basically, so that everyone understands this, what happens is when you have a traditional IRA, you have money in an account that has not yet been taxed. The tax has been deferred. It's a deferred account. A Roth, on the other hand, consists typically of post-tax dollars. The tax has already been paid. And so when you have a traditional IRA, you more or less should probably assume something like about a third of that is going to go to the government when it's taxed. And it will be
Upon distributions.
Upon distributions. Now, again, that could be higher or lower. It depends on your tax bracket.
Right.
It could be taxed as high as 50%, or it could be taxed as high as 70% if tax rates go up. We don't know. Or it could be low.
Or they might even come to a point where they start taxing it inside. I'm sort of predicting
Your conspiracy
I know.
theory,
Yeah.
I know, you keep bringing that up. every
Revenue
few shows.
raise method there.
Well, there certainly could always be legislation passed on, quote, excess distributions over a certain amount. That's, I think, happened before. But we don't know the future. And but the factors that usually go into this are, how many years will I have before I need to take money out of the Roth? The more years you have, the more that money is going tax-free or growing tax-free. So if you convert $10,000 from your traditional IRA, pay the tax on whatever it is, and you may not have to pay much tax if you didn't have much income this year, or if there are certain other factors that apply, or you may have to. The higher the tax that you pay now, the more years that you're going to want it to grow in the Roth to compensate for how much tax you've had to pay. So that's one factor. The other factor is, do you expect or have any reason to believe that your tax rates are going to be lower years from now, or higher? If they're going to be higher years from now, that's another reason to convert to a Roth now.
I suspect they might be higher.
Well, that's the common wisdom, but the common wisdom has often been wrong too. And so a good strategy is to keep money in all different accounts: traditional IRAs, Roths, and taxable accounts.
So you're recommending that your clients have both types of accounts: the traditional IRA that allows you to defer taxes on contributions, and then the Roth IRA, which you put in after-tax money, but it grows tax-free.
Right, you actually get a tax deduction for putting the money in the IRA, right? And it accumulates tax deferred,
Right,
so you get
exactly.
kind of that double benefit. The interesting thing here, though, and again, this is the conspiracy theory part of me, I think what the government, and please do not be listening to the show at the time I'm saying this, I think at some point what they're going to do is, if there's too many people putting money in Roth IRAs, they're going to look at that big bucket of cash and they're going to go, you know what, why don't we just start taxing that? Because remember, Social Security used to be off limits, right? They didn't tax that before. I mean, how can you tax this after-tax money? Well, what's the difference?
Everything's on the table.
Everything is on the table. So
Yeah,
that's just
true.
my own personal thing about Roths.
Right. Well, all of those things are true. The other risk that people take when they do convert to a Roth is that they're now bearing the entire investment, the whole risk of it on their own. Whereas in a traditional IRA, if the government basically has a claim on about a third of it, if the account goes down, you haven't prepaid the tax on it. So that's something to consider as a factor. I mean, it's hard to know how investments will do over the years, but it's good to know that you're going to be bearing the risk of having prepaid the tax, and if the investments go down, it could turn out to not be a great deal. But given the long-term historical record of how investments have done, with a diversified portfolio of low-cost index funds, say, the returns over many, many years have been anywhere from 6 to 8%. Will that continue in the future? Nobody knows. But we all have to make some plans and use some assumptions.
Are most Roth IRAs self-directed? Because I hear a lot about self-directed Roth IRAs.
Well, the term, and Brian and I were talking about this before the show, the term self-directed from a legal standpoint, or the point from that has often been referred to originally, was simply an account that you had, an IRA that you had at, say, Schwab, that you picked the stocks and bonds yourself in, and that was what we refer to as self-directed.
Traditional self-directed.
Yeah.
If we want really
A
confused.
traditional Roth self-directed.
Well, and self-directed
Sorry,
applies to Roths and to regular IRAs, as well as to your to your 401k to some degree, because you have an investment menu and you can often
Right, you can choose
within that
some-
menu, unless you have a self-directed brokerage account. But nowadays, the term commonly is used when people say self-directed. They mean holding real estate or having an alternative investment
Well, yeah,
besides
because
stocks and
it's not
bonds.
self-administered. You have to have a third-party independent administrator.
Well,
Like, that's,
Well, in an IRA, you can never hold title to the assets. They always have to be held by a custodian or so.
And there's a bunch of custodians I know, some of the largest in the country are based here in the Bay Area, and many of them will allow you, if you have an account with them, you can, as you said, buy real estate, or you can invest in real estate secured notes, you can do equity investments, you can do all
Well, we
kinds of different
have
things.
we have a lot of investors in the Praxis funds that are using self-directed IRA money, and I would suspect, Mark, you probably have some of your investors in private money loans that are also using self-directed IRA
Absolutely, you can
account
invest
money.
in what's called trust deed investments,
Right.
which is really a financing instrument.
So this is where we're getting into real estate and alternative investments within an IRA, and that's
Well-
what we call a self-directed IRA.
Well, I actually have a question about that, and that is, with holding real estate in an IRA, obviously you have to make sure that the title is held properly.
Correct.
Yes.
But also, how do you handle the unrelated business taxable income from that?
yeah,
Because
anything over $1,000.
Over $1,000.
Or on leveraged real estate, if they own leveraged real estate within the portfolio, then they could be subject to that UBIT or UBTI, as it's sometimes called. And what we've found with some of our clients is they're going to be subject to that unrelated business income tax, but with the high returns that they're getting from making equity investments, they're netting more money even after paying that tax.
So
than they would
investing
have
in,
otherwise.
well, wait a minute though, people investing in your funds, are they gonna actually be subject, their IRAs, to UBTI?
Yeah, they are in a lot of cases. If the property is leveraged, which in most cases property is typically leveraged, then they'll be subject to the tax. I'm not quite exactly clear on how this works. You almost have to be a tax attorney to figure it out. It's so complicated, but it's on the portion of the investment that's levered. So if you own property that's 80% levered, 20% cash, then you're going to be paying UBIT somehow calculated off of 80% of the value of that asset.
Okay, and on that,
It's confusing.
and on that confusing
Yeah.
break, we're gonna go to our second commercial break. All right, here is the second trivia question. Again, the theme is who blew it? This Dallas Cowboys defensive tackle blew it twice, both in 1993. In the Super Bowl against the Bills when he had the ball knocked out of his hand just before scoring a touchdown, and the other against Miami on Thanksgiving when his failed attempt to recover a blocked field goal in the snow cost his team the game. Who blew it? The first three callers with the correct answer win a free 3-day 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. This Dallas Cowboys defensive tackle blew it twice. Blew it twice, both in 1993. Once was in the Super Bowl against the Bills when he had the ball knocked out of his hand just before scoring a touchdown, and the other against Miami on Thanksgiving when his failed attempt to recover a blocked field goal in the snow cost his team the game. Who blew it? Call 888-912-1190. Make sure to include your name, address, spell your email address, please, and phone number, and we'll be